All right, I think we are live, and we have a loaded panel today, so a lot of topics to get through, so I'm going to dive right in. Welcome, everyone. Thanks for joining us today on our panel on custody, payments, and security of CBDCs and other cryptocurrency. My name is Ryan Todd. I'm a research analyst at The Block, a news, media, research, and information services company for digital asset industry. I'm joined today by five panelists today, so a pretty deep bench. But to save some time, I'm going to introduce them myself, and then we can dive right into the questions. Starting with Olaf Ransom. Olaf's been working in banking for over 30 years now. Sorry to date you, Olaf, but a wide range of experiences in banking, and is currently serving as CSD function head at Six Digital Exchange. We have Lior Lamesh, co-founder and CEO of GK8, a cybersecurity company. They offer custodian solutions and safekeeping, managing digital assets. We have Diogo Monica, co-founder and president of Anchorage, a leading cryptocurrency custodian security firm. We have Salvatore Ternullo, director and co-lead of KPMG's crypto asset services division. He's responsible for driving the firm's crypto and digital asset strategy, innovation efforts, and market delivery. And then last but not least, Pamela Clegg. She's director of financial investigations and education for CipherTrace. They work with governments, law enforcement officials, regulators, law firms, financial institutions globally, and they do blockchain forensics. So I think just diving right in my mind, I feel like it really, 2020 has been a lot of things. But when you're talking about digital assets, I think it's really been a banner year for financial service interest and movement into payments, custody, and security of digital assets. And we've seen this expressed in not only the headlines, but tangible developments. But in terms of headlines, we've seen some of the world's largest payment companies accelerate a strategic desire to expand crypto capabilities, whether that's publicly marketing the intention to explore these offerings, or even just actually rolling out new product offerings and services and servicing the digital asset industry. And I think while it's often a theme that we hear during events such as this and panels of the institutions are coming, and the narrative that we've heard now for multiple years, I think just the caliber of names and interest that we've seen building within broader financial services and directed towards this industry, in my mind, has exceeded what I thought we would see this year, especially given everything else that's going on around the world. But I think just this kind of headlined, whether it's PayPal exploring crypto buy-sell capabilities to its 300 million users, all the way to Square continuing to see continuous pickup in Bitcoin sales through its Cash App. Sold over $2 billion worth of Bitcoin in the past 4 quarters alone. To even news of Mastercard recently testing a platform that will allow central banks to evaluate digital currency systems, among other developments. And I think just stepping onto the CBDC front, it's surely a topic that has seen its fair share of headlines and developments, and an absolute explosion of public research coming out this year, not only from smaller economies and developing economies, but even G7 countries ramping up public efforts to test and research their own CBDC implementations. Just going off that, last week we saw the EU finally release their report on what a digital euro could look like, and the need for them to feel like they need to be, as a bloc, prepared for the eventuality that they might need a digital euro. And then, of course, the 800-pound gorilla within central bank digital currencies, China's digital currency electronic payment system. I saw a report earlier this morning that I guess the PBOC deputy governor said that the trial for that system has already processed over $150 million worth of volume. So that's a live pilot of a CBDC. And so when we think about this year and just the headlines that have happened around some of these events, another thing that often gets kind of pushed to the side, but is equally critical, and what I want to really start this conversation with is we've seen legitimate progress around regulatory clarity for companies looking to service digital assets, specifically around custody, whether that's the US OCC interpretive letter, which provided clarity for national chartered banks to custody crypto, service the crypto industry, and even more recently provided a separate letter that said that banks can hold reserve assets behind stablecoins. All the way to across the pond, the EU just released a pretty comprehensive 180-page legal framework around crypto assets and stablecoins. A lot of stuff going on. The TLDR is there's a lot of stuff going on. But I think a good place to start this conversation would be in each of your own views, starting with Olaf. What's been the biggest challenge you would say for a traditional bank to start offering custody of digital assets? And given even the most recent developments, what challenges still remain in your view?
Right. Thanks very much, Ryan. Good afternoon, everybody, or good evening, depending on where you are. I think for the banks, what's been hard is looking at this crypto world, the initial reaction that I've seen, and Switzerland's got plenty of banks, right? So a lot of what you're seeing is, oh, this crypto stuff, we don't want anything to do with that. And they put it to one side and they said, we're going to do proper digital assets, almost a tokenized version of stuff they've done before. And meanwhile, crypto, particularly cryptocurrencies, has gained more and more momentum. There's more and more demand for it. The clients have perhaps tried to do this a bit for themselves, and I have too. And it's actually quite difficult, all the services you need. So at least around here, some of the clients seem to have turned around to their banks and said, hey, banks, we want you to offer us this stuff, much like you offer us shares and bonds and mutual funds and all the rest of it. And the banks have said, okay, we'll look into that. And the banks have started looking into it. They go, well, we thought it was scary and we shouldn't do it. Now we'd like to do it, but it's actually quite complicated and there's lots of things we need. And so the banks are under pressure from their clients to try and find solutions to this. And you actually need quite a number of different pieces, different services to make this thing work, from custody to how do you get the client's assets to an exchange or from an exchange when they're done, how do you get the cash there? And it's not quite the same as the securities world that the old guys like me are used to, with settlement, delivery versus payment, and central securities depositories. So I think what's impressing me at the moment is the amount of, if you like, the head of steam from the clients and their banks to say, hey, let's get some serious infrastructure solution in place that's, proper in the worlds of old bankers like me, with the right controls in place. So we're seeing that dynamic, that there's an expectation we can get good quality infrastructure.
Hi, Jonin. So good afternoon, everyone. So I couldn't agree more with Olaf. I think that there are three major obstacles for banks to get into this space. The first one is the regulation. Ryan, as you said yourself, it looks like it's very much progressing in the past year. It started with the BaFin regulation last year, continuing this year with the last notice of the OCC on last July, even in Russia and in Europe at the moment. But clearly, in my opinion, the biggest obstacle is the lack of technology knowledge, and specifically the security. We all know that in the past 2 years, billions of dollars were stolen among financial institutions that offered cryptocurrency services, mostly crypto exchanges. In 2018, it was $1 billion. In 2019, it grew in more than 400% to $4.6 billion. So it looks like banks need a true partner, a true solution provider that can providing them with end-to-end solution. So they will be able, even though the lack of knowledge, to offer different financial services they used to do with fiat money, but this time with blockchain-based assets. Yeah, that's what we offer in GK8, a full end-to-end solution. So we are partners of the banks. We're providing them with all of the components they need. So it's something that makes their life easier to dive into this space.
Yeah, I'll jump in and say technology is the most obvious one, of course. I think two others that are equally interesting are the fact that the banks are looking at what products to provide, and they realize the space is actually really competitive already, and they can't simply get a technology provider and create a hodgepodge solution. There's really good systems in place. There's already integrated custodians. There are people that provide prime brokerage-like services, and custody really isn't the service that is going to get clients to your platform. It was 3 years ago when there was no institutional custody solutions, but now we have actually really good custody solutions in market, and a lot of them are providing a lot extra services that are not just custody. Then the third point, technology, product, and then the final point would be risk tolerance. A bank is not going to jump into crypto assets and going to do every single top 100 crypto asset and go and support Uni and SushiSwap and all of these other assets. It's very clear that they'll jump into Bitcoin first, which is already the most served asset in place. And so what ends up happening is that it's non-competitive. The product that they would offer custody for Bitcoin is no longer competitive, and they won't actually have the risk tolerance to actually go further downstream to actually assets that are more competitive or whose custody actually is needed.
Yeah, so maybe stringing together a couple of points that Olaf made and Lior made alongside Diogo's, and kind of the way that I look at these obstacles or hurdles to adoption are kind of similar in context, but I think that the first piece that we really think about from KPMG's angle in helping our clients navigate these challenges is starting with the overall risk profile of the business end to end and engaging with the assets, and how that fundamentally changes or impacts existing service lines as it relates to, frankly, the design of the business from the ground up, how you want to build shared services or not, and keep certain components at arm's length versus others embedded within the mothership of existing operations. And then obviously on the security side, which is something Lior hit on, has been a critical challenge in the space for a long period of time. And I think obviously the maturity of institutional custodians and kind of the competition for that base layer custody has pushed people to move security to the forefront of decisioning, which obviously is very much so aligned with the GK8 viewpoint. And then I think the third piece, which lends itself perfectly to Pamela's discussion, is really around regulatory compliance as it relates to operating the business. And how do you do that in context of global regulatory frameworks, which have some guidelines for how to operate with each other, but have not codified those things and defined, consistent regulatory constructs. So there's a lot of progress being made as it relates to standards to facilitate travel rule compliance on chain with BIP 75 and other things that affect, but there's a lot that goes into both the security and the compliance of running businesses in the space.
Yeah, building upon everybody's points were pretty spot on there. Going last here, there's a saying that we have at CipherTrace, which is either as a bank, you're either doing crypto or you're having crypto done to you. So I think the important point to mention up front is that banks are already touching crypto, whether or not they want to or not. And they are touching it, maybe not directly, but they're touching it indirectly with their customers that are buying and selling crypto via any type of VASP that is coming in some type of payment rail to or from the bank, right? So I think that's an important point to point out, is that banks maybe don't know that they have crypto on their payment rails, but it's there, right? 10 out of 10 of the top US retail banks have crypto in their payment rails. And then the other point here is that, VASP really require that direct connection to payment rails. That is really, when we talk about the price of Bitcoin, right? What are we talking about? We're talking about the price of Bitcoin in a US dollar or in euro, right? So we're connecting that to fiat payment rails in some way. And so it's really imperative to have that connectivity to your bank. Most of us, I would say, that invest in crypto probably do so via, wire transfer or ACH directly from our bank accounts. So I think that's important to note, and that it's important for banks to learn, and they're starting to learn, and we're seeing this, and I think that's why this has been such a banner year. It's important for banks to learn that not all crypto is bad crypto, right? there's good crypto out there, and there are ways to determine the good crypto and the bad crypto, you know, and that's what a lot of us, you know, KPMG, 3C Advisor, CipherTrace, you know, we work with banks to help them identify the crypto that's good and bad, right? So that is kind of where we're stepping in from the outside, because to be honest, you know, it takes time to build these capabilities in-house. And so it really is imperative that they look outside, that they look for you know, a third-party vendor to really assist them in identifying the crypto and then risk rating that crypto, and then making sure that that crypto fits within their risk appetite. You know, what is the bank's risk appetite, and are they open to that? And then the regulatory piece, right? You know, how is regulation? We all saw the FinCEN leak, what, 2 weeks ago now, you know, 10 days ago. I'm not exactly sure what day I'm on, thanks to COVID-19. I think we're all out of date, but you know, we all saw that FinCEN already has trouble keeping up, right? FinCEN, the US FIU, for those that are overseas, you know, they already have trouble keeping up with suspicious activity as it is, right? And so now we're going to add this additional piece to it. You know, we want to, you know, the digital dollar project, right? We want to modernize the payment infrastructure, which is amazing. It's great, and it is necessary. But how do we also modernize the regulatory aspect of that at the same time so that they can keep up with the new payment infrastructure that's going to be in place, right?
Pamela, you talked about modernizing this payment infrastructure, and you mentioned the Digital Dollar Project, which is trying to push the conversation forward in the US for a central bank digital currency. We don't have much time, so I'm going to shift gears now to that. There's still lots of things I would have liked to talk about in terms of the OCC letter, but in terms of central bank digital currencies, I'm wondering if each of you can talk through what you see as risks and opportunities, and how the organizations that you each represent could play a role in this hypothetical emergent ecosystem. And try and be mindful of time.
All right, so we'll go from the top again. So CBDCs, you've got to divide into retail and wholesale. On the retail side, I think they can be useful if you have an underdeveloped and backwards country like America, where you guys are still using the check. I mean, there are no other words other than backwards for that, sorry. So that's the first. You can take a giant leap with that. What I think what it also does is, if you're distributing welfare, which a lot of countries have been doing lately, once you get into digital and smart contracts that go with it, you could literally say, hey, the state of New Jersey is paying some welfare benefits, and you guys have to spend the money in the great state of New Jersey. And by the way, you can't spend the money at the liquor store, for example. So it's good for advancement, and it's good for targeting spending. So that might be useful in retail. Terrific. On the wholesale side, if we're going to have tokenized assets and have peer-to-peer markets, you need tokenized cash to settle it. And there are people working on that. There's two flavors of that. One is the reserve-backed digital currency idea that says there are private organizations that hold reserves. And the thing you've got in the States, where the stablecoin operators have some money with a bank, that is not a reserve, not by any stretch of anybody's imagination. All that means is there's some money in an account equal to the amount of stablecoin. It doesn't mean that the bank that you've got it at is holding that money for real and it's ring-fenced. So that's a kind of amateurish solution that's half-assed, but some people will buy it. There are better things out there. There might be a CBDC solution. The Swiss are working on one of those, or a reserve-backed digital currency. Finality International, I've done some work with, are working on that in 5 different currencies. That's important in wholesale. If we can get the payment piece right, it's an enabler for the tokenized assets, and it's a big enabler for the balance sheets of the bank.
Yeah, I believe that the CBDC and tokenization open huge opportunities this day. I think it will be sooner than we think. I would still take it again to the security issues around it. I still believe that the security is one of the biggest issues right now in order to make such things happen. Only last week, $281 million was stolen by one of the biggest Chinese exchanges called Qcoin. And I think that in order to actually make tokenization of real money and to make a large adoption among those countries, the needed infrastructure should be something that will allow make the money movement and the token movement in a way that is not exposed to such cybersecurity attack vectors. So along with this opportunity of the tokenization of those assets that can save a lot of money and a lot of efficiency for the way that the countries are operating, I think that the security issues is one of the most painful one. The existing solutions on the one hand, I believe are not secure enough. Hot wallets, even the most sophisticated ones, are not secure enough, as even the multi-sig and the multi-party computation ones require hackers to compromise not one party, but only 2 or 3, which means that, that still the return over investment for them to invest few millions to still billions is still there. While on the other end, cold wallets are not really cold. We see that any solution at some point requires bidirectional connectivity and exposed to cybersecurity attack vector. And I believe that only through a solution to enable blockchain money movement without being exposed to cybersecurity attack vectors would be something that enables the CBDC actual take part.
Yeah, I would say one thing, which is what is clear this year is that there's been a huge growth in stable currency usage, right? There's over $20 billion of market cap. It had triple-digit growth of use from last year. So clearly there is a need in the market. Part of the need comes from the efficiency. Part of the need comes from, you know, how the current crypto market is structured. But there's clearly needs here. There's efficiency gains that are done by having digital assets that actually fit cleanly into this economy. So to that end, I do think that having a stable currency that is backed by a central bank definitely brings trust and a lot more adoption. I think there are issues, counterparty issues, smart contract issues right now that we have in place that would be eliminated if there was actually a central bank backing this and running this technology. I think there will be efficiency gains. And to another point is there's a lot of things now that can be done that couldn't really be done before. In Europe, we're talking about central banks having direct relationships directly with the citizens of each country. That becomes a lot easier if you have a central bank backed digital currency to effectively be able to distribute cash directly towards the citizens of the European Union, or maybe in the US directly the stimulus checks towards the wallets of 300 million people. So there's a lot of benefits that come from this, and definitely the technology is there. We can do it, and it will definitely have huge effects on how the current payment rails work, and a couple of different use cases that today are just harder to do that might actually be enabled by having us do this.
Yeah, I think if you pick up the OCC piece that in the context of this too, I think the movement that we're starting to see in the pace of regulatory clarity that's being driven to market is sending strong lead indicators to the private sector that there is progress being made in CBDC research beyond just what's publicized in the context of MIT and the US system. But I think that play of determining on Olaf's basis of retail versus wholesale and what is the trend of adoption within that monetary system will determine the kind of design in which the central bank will pursue the progression of that design, and then identify what the opportunities and potential threats are as it relates to commercial actors in that space. And I think, again, if you put this all in context, the move forward towards CBDC is going to be laid with, you know, progressive regulatory agendas that maybe haven't existed at this frequency in the past. And I think that's what we're starting to see, at least in the US and more broadly as well in Switzerland and Germany too.
I would agree with everyone. And I think looking at it from, you know, the security aspect, you know, Lior looked at it more from the actual custody, the central bank side, right? The controller side. If we put that into the hands of the users, you know, what type of security are we expecting them to employ? What type of security are we expecting them to have on, you know, wherever they're holding their CBDC wallet, right? We look at the United States alone, we still have, per the FDIC, we still have 8 million unbanked and we have 24 million underbanked, which would generally lead to the conclusion that these individuals don't actually have enough cash to open the bank accounts that they need to open. So now we're expecting them to purchase a $500 smartphone to go along with that so that they can receive their CBDC for, you know, whatever type of activity that they're engaged in. And then I also think it's going to come down to adoption as well, right? So is this going to be possible if Apple or Google don't put this in their app store, right? I don't think it would be possible without Apple or Google. But once that is adopted, now how many users have we reached out to, right? So on the user side, and then also just understanding, I mean, let's be honest, utilizing crypto, whether it's CBDC. And by the way, I do think that if there is a CBDC, it should be some type of DLT. I know that there are some experiments with creating CBDC that is not utilizing DLT for the underlying technology. But, CipherTrace alone, we get 100+ requests for investigations a week from individuals that have, suffered malware, SIM swaps, any type of hack, some type of scam. So, that's a lot of technology for an individual to understand, especially in a country, as Olaf pointed out, that still uses the check.
Nice. Thanks everyone for being so quick. I guess rapid round, in 30 seconds, if you could just highlight an event or development that's happened this year that fits within this conversation and why you think it will have implications for the digital asset industry. Start with you, Olaf. So, one event that we haven't talked about yet.
A highlight event that we haven't talked about, crikey. I'll pass and let the next person do it, and if I come back to me, maybe. Lior?
I can jump in. I would recommend the travel rule. I think we have definitely seen movement on the travel rule and addressing it. Somebody mentioned, BIP 75. We've got, CipherTrace is a building partner of and pushing, Trissa. We have tons of other solutions that are out there. And I think it's really bringing together the crypto industry globally to address something that, is really kind of, it's here to stay, right? And it's something that, FATF has definitely said is going to happen. And it's something that we're just going to have to, overcome, even though the technology isn't there right now. That's not an excuse. So, the industry working together to address that issue.
I would say that the rise of yield generation as a successful go-to-market for a lot of these new crypto assets is definitely the highlight for me. We are creating really good go-to-markets for people that are outside of the space to actually come into this. So yield generation might actually be, the killer feature or the killer app of digital currencies. And so that's actually something that has the potential of bringing a lot of people that are not into crypto or they're not in crypto right now into crypto. So I think that's really exciting.
Yeah, and the last thing I would point out is the comments made last week from Jay Clayton and the recognition that on a future basis, all equities or stocks could be tokenized. And I think this sentiment and tone that you heard expressed in that conversation between Jay and Brian Brooks is not something that we would have heard even 2 years ago. And I think that there's more pragmatic reality in everyone's approach towards tokenized securities today, better, more mature product capabilities to support that. And I think the tone at the top is shifting. So that's a major indicator as well.